Welcome to the Deep Dive. Today we are on a critical mission. We're mapping the huge national shifts in capital markets directly onto the retail opportunities right here in Dallas-Fort Worth.
It's a really pivotal moment. We're navigating what feels like a fundamental market paradox.
That paradox, explain that.
Well, on one hand, you have massive institutional capital finally confirming that the commercial real estate recovery is, officially underway.
Okay, that's the good news.
But at the same time, the national retail sector is facing some very real headwinds as we look towards 2026. The consumer is just wary.
So that divergence means just buying retail as a category isn't a strategy anymore.
Not at all. You have to be incredibly selective, very precise.
And our goal today is to really detail where that precision needs to land for investors here in North Texas.
Exactly. To start, we really have to understand the macro flow. I mean, where is the capital going? And more importantly, why?
Let's do that. Let's unpack that macro picture, starting with this confirmation of the market bottom.
We have a firm institutional consensus on this. JP Morgan's global head of real estate came out and confirmed that CRE capital markets effectively bottomed out at the end of 2024.
And this isn't just a feeling, right? This is backed by data.
It's totally data-backed. It's visible right in their own performance. JP Morgan's own massive $80 billion CRE portfolio has appreciated sequentially every single quarter since that trough.
So we're out of the valley.
We're out of the deep valley. And crucially, that valuation disconnect we talked about for so long.
That gap between what sellers wanted and what buyers would pay.
Right. It's evaporated. And that's mostly because of a more stable interest rate environment and, financing is finally flowing again.
So the clock is really ticking for anyone who's been waiting on the sideline.
It really is. The prediction making the rounds now is that 2026 should be a great vintage for new investment.
But if you wait until 2026, you've missed the bottom.
You've missed it. Prices will have already moved higher. This creates a tactical need to deploy capital now to capture assets on the lower end of that recovery curve. The biggest risk today is inaction.
Okay, so that's the optimistic view. But we can't ignore the other side of the coin, this huge volume of maturing debt hanging over the industry.
That is the necessary cautionary tale.
Yeah.
MSCI is basically warning the industry to brace for a pretty significant wave of maturing debt distress.
And foreclosures.
Projected for 2026. This is all legacy debt, originated years ago when rates were near zero.
And now it has to be refinanced at much, much higher costs.
Exactly, which just squeezes profitability and liquidity right out of an asset.
And it doesn't seem like the Fed is in a hurry to help out.
Not at all. Dallas Fed President Lori Logan recently doubled down on the need for caution. She's favoring holding rates steady.
Why is that?
Because inflation is just proving sticky. It's hovering around 2.7%, still above that 2% target. She argues financial conditions just aren't restrictive enough to warrant major easing yet.
So, if the traditional banks are staying cautious, where is all the liquidity for new deals and refinancing actually coming from?
This is the real story right now. Private credit funds.
Okay.
They've stepped into the void that was left by the more risk-averse banks. They are the dominant capital source today, deploying just massive sums of money.
We're talking billions, right?
Billions. We're seeing commitments as large as $2 billion for, very high-demand specialized assets like data centers.
So what lets them succeed where the banks are pulling back?
It's a few things. Private credit funds have fewer regulatory constraints. They can underwrite and take on higher risk. They also specialize in structured finance. They're the ones providing what's called gap equity to fix broken capital stacks.
Okay, hold on. Broken capital stack. That's some heavy industry jargon. Can you break that down for us in practical terms?
Sure. So think of the capital stack as just all the layers of money used to buy a building, debt, equity, everything. If an asset was bought 5 years ago with a lot of leverage and now its value has dropped a bit, the owner can't get a new loan that's big enough to pay off the old one.
So there's a shortfall.
That shortfall, that gap in the financing.
Yeah.
That's the broken capital stack. And private credit comes in to fill that gap equity, which lets the deal get done.
That makes perfect sense. So you have this confluence of institutional buyers and non-bank debt all targeting value now.
Absolutely. And that really sets the macro stage for retail, which, as we said, presents this central contradiction.
A contradiction being that investor appetite is high, but the actual health of the tenants is strained.
Precisely. Let's dig into that. Investment sales volume for retail properties is up significantly, a really robust 21.7% year over year through Q3 of 2025.
So buyers are clearly confident.
Deeply confident. It signals an aggressive appetite for quality, stable retail assets, the durable defensive stuff.
But then you look at the stress on the tenants themselves.
And the stress is undeniable. In 2024, we saw, 7,327 store closures, and that number actively outpaced new store openings.
That's the clearest signal you can get.
It is. It tells you that rising costs and softer consumer spending are really taking a toll, especially on retailers that are poorly located or just aren't differentiated.
And the big litmus test is happening right now with the holiday season. What's the outlook for November and December?
It's a muted forecast, which is worrisome. The holiday season defines the entire year for a lot of retailers.
Right.
So while total sales are expected to cross $1 trillion for the first time, the growth rate is projected to be the slowest since 2016.
How slow are we talking?
The NRF is predicting maybe 3.7 to 4.2%. Deloitte is even more cautious, down at 2.9 to 3.4%.
That slow growth points to a very, very careful consumer.
Exactly. Shoppers are aggressively hunting for bargains. They're projected to spend about 12% less on non-gift items for themselves.
Which forces retailers into heavy promotions.
Heavy, continuous promotions. It protects the sales volume, but it absolutely crushes their margins.
So in this kind of environment, what part of the retail world is actually proving to be resilient? Where's the safe harbor?
It's all about necessity-based retail and high-quality, high-performing locations. Take a look at the mall giant Simon Property Group. They actually raised their funds from operations, their FFO forecast.
And for our listeners, FFO is basically the key cash flow metric for a REIT.
It's the critical metric. It's a much cleaner picture of performance than net income for a landlord. So Simon raising their FFO forecast means their underlying business is getting healthier.
And the numbers back that up.
They do. Simon's citing really robust leasing activity. They hit 96.4% occupancy, and their average rents climbed significantly to over $59 a square foot.
These are the A malls, the top-tier properties.
Exactly. And the same defensive strength, of course, applies to grocery-anchored centers.
Always a fan favorite for investors.
Always. Regency Centers, which specializes in this space, also raised its guidance. As inflation stays high, consumers have to prioritize essentials. That means stable traffic and consistent rent checks for these centers.
Okay, so this brings us right to DFW. From our perspective on the ground here, we see how strong local fundamentals can create a real buffer against that national volatility.
Oh, DFW retail really is the sleeper hit of the Texas CRE outlook. We have this robust shield against national instability because our market vacancy is under 5%.
Which is incredibly tight.
It is. And in our strongest submarkets, average rents are already topping $25 a square foot. It's that combination of limited new construction and just incredibly sticky tenant demand.
And we have to talk about the single most fascinating local development right now, which is Ross Perot Jr.'s landmark mega project up in Denton.
This project. A $10 billion, 3,200-acre master plan community. It is a case study in strategic retail placement. Hillwood is flipping the traditional model on its head.
They're going with a retail precedes rooftop strategy.
Exactly. They are making a very deliberate decision to have H-E-B, the beloved Texas grocer, break ground first on a $60 million supermarket.
The H-E-B isn't just an amenity, it's the anchor.
It's the anchor. It's designed to drive all the future residential and commercial density. The plans include 6,000 homes, 3,000 apartments, 900 acres of commercial.
And a new H-E-B is a powerful engine. What kind of ripple effect does that have?
The data shows a new H-E-B typically spurs an additional 430,000 square feet of nearby retail development. For investors, following H-E-B's path in North Texas is paramount.
And it's not just new development. We're seeing smart value-add repositioning in established DFW submarkets, too.
Definitely. Look at Fort Worth's north side near the stockyards. Local investors just bought the 53,000 square foot Mercado building.
And what's the play there?
The critical move is shifting the ground floor entirely to retail and restaurant space. They're capitalizing on the area's incredibly tight 3.7% retail vacancy and all the tourist traffic from the stockyards. It's a really intelligent, precise move.
And the big national retailers, they're signaling their belief in DFW suburbs, too.
Target is the perfect example. They're boosting their capital spending to $5 billion next year. That's a $1 billion increase,
And what's that money for?
specifically to open larger format stores, about 20% bigger than their average. And that extra space is all going to higher margin grocery and online fulfillment. It's a massive vote of confidence in the DFW suburbs.
There was also some important news for downtown Dallas.
Yes, the 115-year-old Neiman Marcus flagship got a crucial temporary reprieve. After a lot of civic pressure, Saks agreed to keep it open through the 2025 holiday season.
It's temporary, but it's vital.
Absolutely vital for sustaining the retail momentum downtown, especially with the World Cup coming in 2026. Every anchor matters.
So to put a final frame on this, we have to look beyond just retail at the other huge drivers cementing North Texas's stability.
The biggest story there is the long-term demand from AI infrastructure. Google just announced a massive $40 billion investment through 2027.
$40 billion.
Yeah. It's a foundational commitment. They're building 3 new data centers in Texas and expanding their Dallas Cloud region and Midlothian campus. This reflects what's being called the AI-driven energy bottleneck.
Meaning the demand for computing power is creating this secular long-term demand for infrastructure.
Exactly. And those investments provide a huge cushion against any short-term economic dips.
And on the residential side, which supports retail, DFW multifamily is finally showing signs of stabilizing.
It's been oversupplied. Vacancy is still high at 11.8%. But the crucial positive sign is that absorption, the rate units are being leased, is finally exceeding new deliveries.
And we're still seeing investment there.
We are. New workforce housing projects like JPI's recent $103 million start in Denton show that stable, affordable housing demand is still there, and that underpins retail demand.
Well, let's bring it all full circle. We have the institutional recovery, the cautious consumer, and massive local investment. What's the ultimate takeaway for investors looking at North Texas retail?
The two realities still exist. The capital market has pivoted to recovery, which means you need to act. But the day-to-day retail environment is volatile.
But not here.
For DFW, strategic retail investment remains exceptionally strong. Our local fundamentals, low vacancy, rising rents, are protected by these huge long-term anchors.
The stability of an HEB, the foundational commitment from a company like Google.
Right. The DFW market isn't just reacting to trends, it's being intentionally and strategically built for the next generation of growth. That intentionality is the key.
And that strategic approach leads us to a final provocative thought for you to consider. The HEB strategy of retail preceding rooftops in the landmark development. Well, it suggests that future suburban growth in DFW will be dictated less by housing starts and more by anchor retailers.
So the question is, will other developers adopt this retail-first blueprint across the Metroplex? And could that fundamentally change how new DFW communities are built and where capital flows first? That's a shift we'll be watching very, very closely.